Yeah, you got 3. Mongolia. Yeah, Mongolia. The word with John Red or Conrad? Sir.
Hey, Rachel.
Oh, everyone. Yeah, everybody has a shot. They're this is
Romy,
I guess.
Does it sound like the projector?
Yeah.
Also, can you? Adam said he might be able to join.
Well, there's an extra cell of computer desk, but we have to
Yeah, no, that's mustard.
I use that coffee. Will not be tomorrow.
I think it's just like this. I'll go today off tomorrow.
You gotta take us. And so that's why so should we kind of ask him to take a look at it today?
Yeah.
Yeah. Otherwise we're going to send out this.
Whatever you need. Thanks, sir. All right. Can you pass me the Brian?
Oh,
Thanks for being
hey everybody, so today I'll be talking about monetary policy and banking. And we're just going to start with a short MobLab activity while everyone's getting settled into the classroom today. So when you sign in, you're going to go ahead and find your active session. And there's just a quick free response question on how do banks make money. This will not be graded, and it's just your thoughts, short phrases, 1 to 2 sentences, and we'll get underway in about 2 minutes or so. And if you need the class code to join the class,
Bank Island?
yes. The active session name is Bank Island, and if you need the code to join the class, that will be the code.
How do banks make money? Whoa.
Don't expect my participation right now. My phone is updating. Can't use it. Yeah, but they know how do they embezzle money, right? Swiss banks do this.
It's steal it. Is that?
No, we're talking about Swiss banks, or
It's like
because they just embezzle money.
borrow short banks.
Oh, that's on the back of the banks.
Oh, wait, can I go back? I think I got it wrong.
The reference you made up.
And this is just to start class, to get thinking in the spirit of monetary policy. It's a little obnoxious. So while you're finishing up your survey responses, I'm going to go ahead and move on to the next slide here, so long as we can get in present mode. Can I move this? Well, oh, there we go. That works so much better. All right, so let's just say hypothetically there is an island bank. And the bank's deposits are $1,000. The required reserve ratio, or the money as the bank would have to have on hand, would be 10%. So therefore, the bank's reserves of this island bank are $100. Now notice the deposits are 10 times as much as the reserves. Are we beginning to sense a multiplier? So the money multiplier is 1 over the reservation ratio. So this is how banks can begin to make money. So what the money multiplier tells us is that for each dollar the Fed increases reserves, and by how much can deposits, the money supply will increase. So if the reserve ratio is 20%, that means the money multiplier is 5. That means each dollar the Fed, that controls the supply of money, injects into banking can cause deposits to increase by $5. So in the real world, the money multiplier is smaller because people keep cash on hand. Banks do keep their excess reserve ratios above 0. And if any more or either of these two scenarios happen, the impact of reserves in the money supply will make the money multiplier smaller. So to begin class, we talked about some ways in which banks make money. So let's go ahead and take a look at those. So to the point, how do banks make money? Well, they have the ability to lend out money, thus talking about the money multiplier. So it looks like all these answers here are correct ways in which banks can make money. Banks are a money-making institution, which brings us to our MobLab game.
Emily.
All right, so as a bank, we're playing an island bank. It takes deposits, which makes profitable loans. You all will be making deposits, and each day you'll choose whether to withdraw this deposit. The bank will fail if too many withdraw, since the reserve ratios on this island are very low. Payoffs. Well, if the bank does not fail, there is a high return to depositors. Say this is a very lucrative island that we can give high returns at. What if you withdraw and the bank has not failed? Well, you'll get back your deposit. If the bank fails, you'll be withdrawing and losing your deposit. So let's see how this looks on your game screen. So there will be 6 investors in each group, and you'll see your initial investment of $100. You'll have a maximum number of decision games, and this game will be 5. And you'll see the bank will not fail if there's under 3 withdrawals. If the bank does not fail, you'll be able to receive $150, so that is your interest on your initial deposit. And then you can always see where you are within the game, seeing the number of folks that withdrew and what day you're on.
What you said, if it's under 3?
If it's 3,
Oh, yeah. So maximum.
maximum
Okay.
3 can withdraw to receive their deposit back. So you have a choice each day to leave your money in the bank or to withdraw. I'd like to remind you that this is an island bank. Our reserve ratios are low, and you should really practice a best response scenario. That being said, it is your public duty. You are on small chains of islands. You will not be all in one group or all in the same island bank. So if for some reason your bank becomes insolvent or people are withdrawing, you need to voice this moral concern with others. So I'm going to go ahead and begin the first bank run game. Note for internal MobLab people, I opted not to run the instruction comprehension survey. I think the choices are pretty clear for students whether you should leave or withdraw in the bank, but the instruction comprehension survey is there. So I'm gonna go ahead and run the game. If you will, I'll click on active sessions and join.
Is this like forced withdrawals or
This one may or may not be.
may or may not?
And just by a show of hands, either in or out, it looks like we have a good chunk of people. Hey, Adam. Good to see you. Da-da. Go ahead, robots to fill that last group.
Wow.
Why?
What's happening?
Somebody just withdrew.
I don't know who it was, but I'm not gonna name you the
Withdraw or withdrew?
Withdrew.
Withdrew?
Yeah.
Oh. Isn't Drew our first name?
Drew. No space there.
Someone.
Nice.
Okay, where's my money? Investment paid off.
We're getting more robots in the bank.
More robots.
Isn't that the answer to everything? No, I'm saying it would be worse.
Oh, my big was insolvent, dude.
Less for
Really?
All right, so the games
I
are
got
just.
$100 though. It's not made it insolvent.
You made it.
So by show of hands, how many people think we're insolvent this round?
For in or so?
Insolvent. How many people lost money? So let's talk about best responses.
Your retirement savings.
So best response, if you knew that 3 people were going to withdraw their money, what would be the best response in this scenario?
Well, to withdraw your money as quickly as possible.
Right. So what we're articulating is a best response scenario. So that's why it's important that you all communicate in this next game to ensure that this group here becomes profitable. So we're going to play that game one more time. And you'll be put in different groups. You know, I know some people may not be as trustworthy as others.
Days 10, 30, maximum. Forced withdrawal chance of 40%.
Oh man.
Oh. Now I'm thinking I'm just going to withdraw.
So we should all.
I think I'm just going to go for it. I think I'm
Oh,
going to
you
withdraw.
fool.
I'm going to
I was stung by a jellyfish.
I'm taking it out.
Wait, why did I only receive 50?
I had to get out.
Because your bank was insolvent. If a bank goes
Oh,
insolvent, you may
man.
not receive all of your money.
I had to get out. That just scared me. That little last clause, that just scared me.
40% is a lot.
So let's talk about that last game, shall we? So what happened there? Well, there was really low public morality.
Yes.
After that first round, we heard about one bank becoming insolvent, and clearly our robots caused a sense of panic after hearing that.
Yep.
So let's take a look at the results from our first 2 games. So this is our first bank run game. And we can see that one bank did fail on day 3, and another bank didn't fail. Now with a higher public morality or sense of urgency, let's go ahead and take a look at what happened in what that market insolvency could have caused. We see a lot more bank failures as early as day 2, 3, and 4. Now, luckily in the US, we are not dealing with a small bank island where I can induce a scenario in which there is a panic in the classroom. This is because our US banking system is a fractional reserve banking system, which means, yes, banks only keep a fraction of the deposits, but they're backed by the feds. So we have deposit insurance. However, even though banks do keep a reserve and only a fraction of deposits, this does leave exposure to bank runs, like we just experienced. For example, the bank run on Union Bank, one you might be familiar with from a movie, It's a Wonderful Life, and what we just experienced in MobLab. So we're going to play one last treatment with deposit insurance to illustrate how the banking system in America works with that deposit insurance. So you'll at least be guaranteed your $100 should you keep your money in the bank.
So it's fully insured.
Your deposit's fully insured. So I'm thinking through best response scenarios with that deposit insurance. How should you best respond?
I'm feeling pretty comfortable with that insurance.
Nice. $150.
So by show of hands, who is profitable under this deposit insurance scenario? So ideally, with fractional banking in the US with guaranteed deposit insurance, this allows both investors and the banks to be profitable. Let's talk about something recent. We did experience a bank run in this classroom, and we're going to go ahead and talk about the subprime crisis and the bank run on the bank at Northern Rock. So how did we lead up to the bank run in the classroom? Well, there is a loss of confidence in the classroom. You know, there was one foreclosed failure, and then there is a sharing of information. That sharing of information in this classroom was, hey, there is now a forced withdrawal rate of 40%. There's definitely a loss of confidence in this classroom and trust in others. So thinking about the subprime crisis and the bank run that happened, how did the US get out of this recession? Let's go ahead and put it in present mode. So first, let's look at it from a GDP standpoint. So if you remember, GDP is consumption plus investment plus government purchase. That should be minus net exports. That's all right. We'll fix that. So let's think about where GDP was in the state of the subprime crisis. Consumption was definitely out. Morale was low. Consumption was not going to get our GDP back positive. Government purchases. Again, morale was low. That was not going to get us out of the subprime market. Same with net exports. So what was the only tool we had to rely on? It would be investment. And that's where the Fed comes in with expansionary monetary policy. And what monetary policy we used is called quantitative easing. So there's three different monetary policy tools that the Federal Reserve has on hand. One is the required reserve ratio, which we talked about a little bit earlier this class. That's the percent of money of deposits that banks need to have on hand. Two is the discount rate. That's the rate that the Fed charges banks for overnight loans. And sometimes the Fed frowns on too many visits to the discount window. And then lastly, there's open market operations, which is just the buying and selling of bonds and other governments.
Wait, what was the too many windows? Or
Sure.
the Fed frowns on too many visits.
So overnight loans would be an example if I was the Fed and you, for some reason, were a little bit below your reserve ratio.
Right, so I want to take a loan.
Then I could loan you that money as the Fed. But also in terms of monetary policy, what the Fed can do is offer discounts on that lending rate to encourage people to come to the Fed directly.
So that means the Fed frowns on too many visits. Oh, I see.
I don't know why my transitions aren't really working here, but let's try. So let's go ahead and look at monetary policy. So money supply, denoted on the bottom here, the Fed controls the quantity of money. Therefore, the money supply is always vertical. And changes in interest rate will not affect the change in the money supply since the Fed controls money supply. Money demand, the curve is downward sloping. That means a fall in the interest rate will increase demand in money. And at lower real interest rates, businesses will increase investment. So you can see here, at lower interest rate R2, there will be a higher investment. And in terms of shifting, the Fed can shift monetary policy to also lower the interest rate and encourage investment. So recall aggregate demand in terms of our aggregate demand to supply curve. What causes aggregate demand to shift to the left? Changes in consumption, changes in investment, government purchases, and net exports. So looking again at changes in investment, we can see how the effects of increasing the money supply will shift aggregate demand out. So first, the Fed will increase the money supply, lowering interest rates to R2. That will shift aggregate demand to the right, improving our short-run GDP. And how this looks long-term, again, we're shifting aggregate demand to the left. That means aggregate supply will shift to the right. And we'll find ourselves hopefully at a stable long-run equilibrium. And that's, in brief, what the Fed did to get out of our subprime crisis. So in terms of a banker own reflection, deposit insurance guarantees deposits. And I'm going to go ahead and have you answer a couple short reflection surveys, and I'll go ahead and wrap up the lesson.
policy, it means the insurance policy.
Mm-hmm. So who pays this cost?
This third one.
So the third one, if I can summarize it, which we might find advantageous to do. If I can lead you on a path for that third question, it's asking about what kind of moral hazards does deposit insurance create?
It's what you see already.
No.
All right, and as folks are finishing up, again, just brief responses. This isn't graded. It's just to make the lesson resonate a little bit stronger in your mind. So let's go ahead and talk about that first question. So what was the difference between a game with and without deposit insurance? Well, with deposit insurance, that means you had safety of at least getting that deposit back if others chose to withdraw their money, meaning that your best response should always be to leave your money in the bank. And how we do this in the United States is the FDIC, or the Federal Deposit Insurance Corporation, to help prevent against bank runs, like we experienced earlier in our island bank. But the question is, who pays for this policy? Well, a common macro saying is there's no such thing as a free lunch. You may have heard me say this a couple of times in the classroom before. So who's paying for this? Well, the FDIC is paying for it, and the government's paying for it, and ultimately the taxpayers. So most of the charges from the FDIC currently are generally administrative, but they are the last line of defense in terms of a net bailout. And then what does this protection, what kind of moral hazard problem does this insurance of both deposits and banks have? Well, it sets up a moral hazard problem, and what what we experienced in the subprime crisis. Banks were almost considered too large to fail, and they were making poor loan decisions on subprime bonds. So it may encourage folks to engage in riskier behavior. To sum up the lesson, when we think about monetary policy, the Federal Reserve has three tools: the required reserve ratio, the bank, how much money, what percentage of deposits they need to have on hand; the discount rate, if you were to come to the Fed and ask for money, they could issue a discount rate; and open market operations, which is just the buying, selling of bonds and other government securities. Remember, a change in I, or investment, in GDP. And when we graph this, you want to start with the money market supply, and then use R to shift the aggregate demand curve. Thanks, everyone. Comments, feedback, suggestions?
So I saw this presentation, and you put a lot of the information up front, so this is much better, because you have just a little bit about the game, you go into the game, and then you get to break it down afterwards. And I thought that was much better.
Yeah, I also think the structuring of the three treatments, first having one just the class play, and then having one, but because in the class play it's not guaranteed that bank runs actually happen, but then when you do the robot play,